Thank you for joining this month's webinar, Fourth Quarter Tax Tips for 2014. My name is Carole Foos. I'm a CPA and Director of Tax Planning at OJM Group. We just wanted to share with you today some thoughts as you're all preparing for your 2014 taxes, looking towards the end of the year and thinking about what you might do to save taxes for 2014. I'm sure many of you are still getting ready to file your 2013 tax returns if you filed extensions, so it's a great time to think about what things you can do now to plan for next April 15th. We do have a disclaimer you can see on the screen. OJM is a registered investment advisor, registered with the SEC. This is not investment advice. In addition, we are neither a law firm or an accounting firm, so certainly before doing anything, you should talk to your personal tax and legal advisors about any strategies that we discuss. We do want to offer you, as a thanks for joining us today, one of our books written by our principals. You can see them on the screen. Those materials are free to you as an attendee on the webinar, and I will tell you at the end of the webinar what you can do to get access to those publications. So one of the things we want to talk about today, new tax law went into effect on January 1st, 2013. And again, for those of you who maybe have not yet filed your 2013 tax returns, perhaps you haven't realized or seen the impact of that new tax law yet, but many of you have already filed and know that taxes, especially for high-income taxpayers, increased significantly in 2013. We're really looking at the highest tax environment we've seen in the last 30 years. Many of you now face a 50% plus marginal income tax when you're looking at federal income taxes, the Medicare tax and the surtax under the Affordable Care Act, as well as state income taxes. A lot of states and localities have also seen their tax rates increase in order to keep up with struggles in the economy. So tax rates are generally at least 45 to 55% now, depending on your city and state. And total taxes on long-term capital gains and dividends can now reach 23 to 35%, again, depending on your state. While those items of income have a better tax rate for federal tax purposes, generally on state income taxes, they are taxed at the same rate as your ordinary income. Because of all these things going on in the economy and the rising tax rates, we feel like tax planning has not been as important as it is today in 30 years. So one of the concepts that we think it will be important for you to look at for 2014 and 2015 planning is reducing your taxable income. How can you go about lowering that taxable income so that you're lowering that 50% rate you might be paying on every additional dollar of income? Or maybe you're in a situation where you can reduce your taxable income enough to drop down below that top tax rate. One of the things that you might want to look into doing this year, if you're an employee and you can defer income into a deferred compensation plan, when rates are as they are today, it's a good time to choose to defer income into your employer's deferred comp plan. This will reduce your taxable income, as that income will not be taxable to you. You do want to, in contemplating this decision, examine the plan documents, talk to your employer or your human resources person about that. Often money in a deferred compensation plan is subject to the creditors of your employer. Should there be a bad creditor outcome for them. So you just want to weigh all the options. But again, deferring money into a deferred compensation arrangement can help you reduce this year's taxable income. Also, if you're an employee who has the ability to exercise stock options, you're going to want to weigh that and possibly defer the exercise of those options to a later date. If your 2014 taxable income is going to push you above $400,000 if you're single, or $450,000 if you file a joint tax return, then you might want to defer exercise of options into a later year when you're not in that highest income tax bracket. One of the things certainly that you can do is to fund a qualified retirement plan. If you are an employee and you're not currently maximizing your funding of your qualified plan, you might want to do that. Money that goes into a qualified retirement plan is not included in your taxable wages for this year, so it does reduce taxable income. If you're an employer and you don't currently have a qualified retirement plan at your business, now is the time to consider establishing a plan. Safe harbor 401k plans do need to be established by October 1st, so you're running up against the window for getting those established. A safe harbor 401k plan can allow you as the employer owner to maximize contributions into a 401k plan while providing a safe harbor contribution for your employees. A non-safe harbor plan can be established up until the end of the calendar year. However, you do need to establish them in time to actually defer wages into the plan in order to get the benefit in 2014. So non-safe harbor plans, due to testing and discrimination requirements, may not allow you to maximize the deductions, but they may also be less expensive for you in covering employees. If you're a cash basis taxpayer, business owner, one of the things you might think about doing in 2014 is deferring your billing and collections and accelerating the expenses in your business at year end. Cash basis taxpayers are taxed on the income they actually receive in the calendar year. So if you're not collecting that income prior to December 31st, it won't be taxable until next calendar year. And again, accelerating expenses that you might normally pay at the beginning of January and paying them in 2014 will allow them to be deductible in 2014. If you have some losses that you haven't actually realized that you know are coming in your business, you might want to take steps to realize those losses this year in 2014 in order to deduct them this year and reduce your income. And even on the personal side, you can accelerate your deductions in 2014. This would involve doing things like paying your state estimated taxes by December 31st instead of waiting until January, paying real estate taxes in December that might not be due until January, making your charitable contributions by December 31st. All of these can be done, but certainly you'll want to get with your tax advisor and evaluate the alternative minimum tax impact of doing these things. Sometimes accelerating those itemized deductions is not helpful if you're in an alternative minimum tax situation, as you won't receive the full benefit of those additional deductions. It's also a great time to do charitable contribution planning. Again, in a rate of high tax environment of high tax rates, charitable contributions are a great way to reduce your taxable income. One of the things you can consider doing is gifting appreciated property, such as appreciated stock. Gifting of appreciated property allows you to take the deduction for the full value of the contribution as of the date you donated it. It also alleviates your need to pay capital gains tax on that appreciation. So it's a great way to avoid some capital gains tax while making a valuable gift to your favorite charity. A lot of people are talking about doing things such as establishing a charitable foundations or charitable trusts. These allow you to put money into a, for instance, a foundation, take the deduction today for the money that's put in. There are rules for those foundations, very specific rules, but you can then, over the course of time, through the foundation, donate to various charities. Typically, a charitable foundation has to give away each year 5% of the value of the assets within the foundation. It's a great way also, if you're charitably minded, to perhaps get your children involved in charitable giving by having them serve on the board of your charitable foundation and help make those charitable decisions. Charitable trusts can be established. Again, money can be gifted into a trust for charitable purposes, often even with the income from that trust coming back to you as the donor. Income would be taxable to you, and the remaining property left in the trust at the end of its term going to a charity. You might also want to give to a donor-advised fund. This is another way to make a charitable contribution and get the deduction today while having some input on as to what charities will receive those funds now and in the future. Another way to reduce taxable income today is to contribute to a health savings account. Health savings accounts are available for taxpayers whose health insurance is considered to be a high deductible plan. That means that the minimum deductible, if you're single and have single coverage, would be $1,250 for the year, or for family coverage, you would have a minimum deductible of at least $2,500 a year. Many employers' health insurance plans now are these high deductible plans. If they are, you're allowed to donate up to $6,550 if you're family coverage to a health savings account, and that money that goes into your health savings account is deductible on your federal tax return. If you're age 55 or over, you can make a catch-up contribution of an additional $1,000. Single coverage allows you to donate or to contribute $3,300 to your health savings account for the calendar year. Again, that is deductible. The great thing about health savings accounts is, unlike the old flexible spending accounts for medical expenses, you don't have to use all of that money in a given year. So you can contribute $6,550 each year into your health savings account, build that up. You can use the money to pay for your co-pays and deductibles or prescriptions for medical purposes, but what you don't use stays in the account, and you can use it in the future for medical expenses down the road. If you don't use it for medical expenses, ultimately, and it comes out, it's taxed just like an IRA distribution would be taxed to you. So in addition to reducing your taxable income, another thing for you to consider doing and examining this year is tax-efficient investing. You know, one of the things that we see often when we talk to our clients is perhaps not having the right assets in the right accounts when it comes to their investments. What does that mean? Well, typically, you might want to see your income-earning assets being held within your qualified plan. Income within a qualified plan is not currently taxable, so as income is earned by those assets in the qualified plan, you're deferring the tax until you start taking distributions out of your qualified plan. On the other hand, you might want your growth assets, that aren't paying current dividend income, and your tax-exempt assets in your taxable account, so your brokerage account that's got your after-tax savings. Because these assets have a lesser tax impact, that will make them more tax efficient. Another thing you'll want to think about doing is timing the disposition of your assets in order that you receive long-term capital gain treatment. In order to get long-term capital gain treatment, you need to hold an asset for at least 12 months. So just when you think it's time to sell that stock, if you've only held it for 11 months, consider holding it for another month in order to reduce that tax rate from your ordinary income tax rates, which might be 39.6%, down to capital gains rates of 20%. Another thing to do, especially now at year end, is to harvest your capital losses against your capital gains. It's the time to look at your portfolio, sit down with your investment advisor, and think about, where am I for the tax year in a gain or loss position? If I'm in a gain position, should I be selling some additional assets that are in a loss position to offset those gains? If I'm in a loss position, then I know that I can only write off capital losses if they exceed my capital gains up to $3,000 per year. So maybe I want to sell some assets and realize the capital gains in order to offset some of those losses. You might want to, in that situation, sell an asset, recognize the gain, buy a similar stock back after it's sold, and get that at the higher basis. One of the things you want to be aware of in harvesting capital losses, though, are the wash sale rules. If you sell a stock at a loss, you can't repurchase that same stock within 30 days and still take the capital loss. If you have unused passive losses due to, for instance, rental real estate that you hold that runs at a loss, you might want to consider some investment strategies that create passive income. Passive losses may only be deducted to the extent that you have passive income. So rather than those losses year after year sitting and being suspended, look for some investment strategies that will create passive income, as the tax effect of that passive income will be minimized by the offsetting passive losses. Another thing to do is take advantage of Section 529 plans for college funding. Every state offers Section 529 plans. Certain states have state income tax deductions for contributions into their plans. Some states allow a state income tax deduction for contribution into any state's plan. A 529 plan allows you to make an after-tax contribution for college education funding. The funds within the plan grow on a tax-deferred basis, and distributions come out tax-free as long as the money is used to pay qualified higher education expenses. Another thing to point out this year for investment purposes on taxes is to be aware of the reporting requirements if you have foreign accounts. There are some pretty stringent rules now for reporting of foreign accounts, particularly if you have a foreign account that had $10,000 in it on any given day throughout the tax year. There's reporting that needs to be done, so make sure you speak to your CPA about that if you hold any investments in foreign accounts. Another thing to think about for 2014 tax planning is looking at your corporate structure and making sure your corporate structure makes sense for you. You know, a lot of times what we see is a business owner who started out with their business entity being taxed in a certain way, and that business may have grown and changed completely, but they've never taken a step back and looked at, what's my corporate structure and does it still make sense for me? For instance, you may have a business that is a single member LLC that you treat as a disregarded entity. This may have been great for you when you were the owner and the only employee and you were starting out and it made sense and you could file your business income and expenses on your personal tax return and only have one tax return to file. But maybe you've grown and now you have other employees and your business has changed and not all that income is being derived from your services. If that's the case, it might make sense for you to elect to be taxed as an S corporation. And converting to an S corporation can be done on January 1st, 2015 to be effective for 2015. Actually can be done through the middle of March in order to be retroactively effective as of January 1st, 2015. But an active shareholder in an S corporation who provides services to the corporation still needs to receive reasonable compensation for those services in the form of W-2 wages. However, any additional profits in the business can be realized and passed through to you as the owner on your personal tax return, distributed or undistributed, but those additional profit distributions for an active shareholder aren't subject to the self-employment tax. So again, if you're not the one providing all of the services to your S corporation, make sure you're having it taxed efficiently and not paying additional Medicare tax that you may not need to pay. Another thing to look at when considering corporate structure is, are you maximizing all types of benefit plans? Have you looked at your qualified plan? We talked about that a few minutes ago. Maybe considering Section 162 bonus plans for key employees, fringe benefit plans, non-qualified deferred compensation plans. Look at all of these types of plans and see what works for your business and what meets your tax needs, the needs of your employees, the needs you have for succession planning within your business. And another thing you might want to do is consider a multiple entity structure for both tax planning and asset protection purposes. A lot of times your business is structured in such a way that there really are a few different components to that business, and it might make sense to split the components apart and have them in separate entities which are taxed in different ways to take advantage of the benefits of different types of tax structures, be that an S corporation, a C corporation, a partnership, or a disregarded entity. Here's a little chart that shows you how a multiple entity structure might work. I think in this instance it's for a medical practice. So you might have a practice entity that has a services agreement with a separate management, billing, or marketing entity. Now, in this type of situation, for instance, the management entity provides all the administrative and management services while the practice provides all the medical services. It serves to provide some asset protection by separating out the assets of the business. You might have a traditional benefit plan at the practice level, such as a 401k. There will be affiliated service and controlled group issues, so all employees in both entities would need to be covered. But again, it can make some sense in certain situations to separate out those different lines of the business for risk management and asset protection purposes, as well as for tax planning. And another thing that might be considered for those of you who have larger businesses with a lot of revenue is a small captive insurance company. A small captive insurance company is an actual insurance company licensed by a state department of insurance that provides risk management, for instance, for risks that you currently are either uninsured for or perhaps underinsured for. Things such as deductibles, litigation expense, employer liability, etc., might be covered by your captive insurance company. Section 831B of the Internal Revenue Code does exempt the first $1.2 million of premium revenue received by a small insurance company from federal taxation. And again, if your business has the risk and has a justified need, then they can have an ordinary necessary business expense for premiums paid over to that captive insurance company. These are expensive to set up. They do make a lot of sense, again, for providing risk protection for you. We work with some tax attorneys who specialize in this and have a lot of knowledge in this, and certainly step one in even looking into this, after being educated a little more on what they are, would be to have a feasibility study done to see what risks your business might have, which is not currently being covered by insurance. These can be a great estate planning too, as they can be owned by your beneficiaries or by a dynastic trust. And so this is what a captive insurance company would look like, where you have owners that own a business, and those same owners can own the captive insurance company. The business pays money for insurance premiums to that insurance company, and the captive insurance company provides insurance coverage for the business risks. So a little bit about OJM Group. We are a fee-based consulting firm. We have a multidisciplinary team of experts. We have attorneys, accountants, certified financial planners, benefits and insurance experts, and we work together to provide a comprehensive financial plan for our clients. We have a very focused approach to tax planning, retirement, insurance planning, and asset protection. And we have investment professionals to advise you on investment income with an eye toward those tax-efficient investment portfolios that we spoke of earlier. Next steps, we would love to speak with you and hear from you. Certainly you can receive a free copy of one of the books that I showed you earlier. To take advantage of those book offers, you can see the website for our OJM bookstore on the screen. That's www.ojmbookstore.com. The promotional code WEB0914 will allow you to download one of those books for free. We do have a lot of the books in ebook versions if that's easier for you, or you can order a hard copy. You can also sign up for our e-newsletter. And again, we'd be happy to do a free consultation with you to answer questions about your business and tax needs. You can contact David Mandel at the number on the screen, or email him at mandel@ojmgroup.com. Thanks so much for joining, and we look forward to speaking to you again soon. Please go to our website, take a look at the books, and download one.